welcome to this exclusive webinar with our partners LMRE. My name is Idriss. I'm the founder of Relevation, and we're here to discuss the hot investment trends in the built environment space, including PropTech, ConTech, and everything related to the built world. Before we kick it off, and I let the lead to Dilan, just let me introduce Relevation in a few words. So Relevation, referring to elevate real estate, is a unique concept. It's a fundraising and investment digital summit for PropTech and the built world. So it's basically a transactional event where founders and VCs and exit partners can meet, but as well VCs can engage with co-investors and LPs, and we hold it completely digitally. And to be able to have a great transactional event, we also need to offer great networking features. So it means when you dial in the event, when you log in, you have access to a complete directory with all the other attendees. You can see company one-pagers, send meeting requests. There is an algorithm matchmaking you with the relevant people. And so what's new for this edition, which will be held on 29th and 30th of June, is that we will have a strong focus on everything related to climate, decarbonization, net zero race, fights against climate change. We will also have a strong focus about public authorities and regulators. In fact, the mayor of the city of Brussels has already accepted the participation in one of the panels. So we will have a lot of regulators joining because we think they should be part of the conversation. And also we will have a strong focus on exit partners. So we will invite a number of exit partners, acquirers, but also founders who recently exited. So we have 6 founders who made a great exit in the past few months, who will share their lessons learned, their return of experience to inspire the next generation of founders. But also what is important is that we will, in partnership with LMRE, invite high potentials, students, young graduates from 20 world-class universities to join for free the event. And we will organize speed dating sessions to facilitate the access to talents for VCs, for founders, and for corporates. So this being said, don't miss these unique events where you can engage with 150 VCs, 350 founders, 50 LPs and 100 high potential. I hope the date is in your agenda. And Dilan, the floor is all yours.
Wonderful. Thank you so much for the intro, Idriss. LMRE is certainly very excited to be one of Relevation's sponsors, and we look forward to the event. Equally, I'm excited to be joined by some fabulous guests today to discuss European VCs in the built environment. Now, without further ado, let's start with a brief introduction of everyone. Patric, please do us the honor and start off by introducing yourself and the VC you are here to represent.
Okay, I don't know about honor, Dilan. So my name is Patric. I'm one of the 3 general partners at Foundamental. With Foundamental, we're investing globally in construction technology. So I'm a little bit the outsider in this group because we tend not to do so much with technology that optimizes existing buildings, which I would call PropTech, but our focus is entirely on the other side of the life cycle, which is construction tech. So any technology that basically helps with the construction, the supply chains, the logistics, the renovation. We do that on a global scale, and we manage right now 130 million euro across 2 funds.
Thank you very much, Patric. It's definitely an honor to have you with us today. Always great to have you on one of our webinars. So thank you very much. Kingma, would love to hear more about you.
Sure, thanks, Dylan. So my name is Kingma. I'm the head of UK for PropTech One. We are a Berlin headquartered early stage VC fund that invests into both PropTech and construction tech technologies across Europe. We closed off our Fund 1 at 50 million euros at the end of last year, raising capital from a bunch of different LPs, from institutional real estate companies to individuals as well. And we've made 13 investments so far out of that fund, of which 2 of them are UK based. And that's what I joined PropTech One to do at the start of last year in order to expand our reach more into the UK market, get to know more UK investors such as Conan and many others, and hopefully make some more UK investments.
Thank you, Kingma. Obviously, PropTech One is a very good partner of ours, so also it's a great pleasure to have you on board today. Conan, please also tell us a little bit more about yourself.
Hi, and thank you for having me on. My name is Conan Lauterpacht. I am the founding partner of Sustainable Future Ventures, which is a built environment technology investor, by which I mean construction and PropTech, everything through the real estate built environment value chain. We are a new fund being launched in conjunction with Patric, the international real asset manager. We're targeting early stage, which for us is late seed to Series B companies in the built environment space. We have a particular focus on those that are impacting sustainability, either environmental or social. And we're currently raising Fund 1, which targeted 100 million euros, though we're already deploying from this fund. And we've made 2 investments to date with several more in the pipeline.
Excellent. Thank you so much, Conan. Another really, really exciting fund to have with us today. So first question again towards Patric. Let's start with the beginning. So the fundraising of your VC fund. How was your roadshow and what are your lessons learned about fundraising for a fund?
I can tell you there's, and probably every founder can tell you, there's no fun in funeral and there's no fun in fundraising. That's for sure. And so for us, probably the most recent fundraising for Fund 2, we did a few things differently. And I think they turned out well for us. So maybe I can walk you guys through that a little bit. So the newest fund is 75 million euro. And we basically were on the market only a few weeks. That doesn't mean we didn't build relationships with LPs before. So for us, Foundamental is completely backed by families and operators from the construction world internationally, some of them in Germany and Spain and other countries. And so what for us is very important is that in between fundraising, when we're not on the market, to build these relationships early and make sure that those operators and those families get to work with us on some level. But ultimately, when we do start fundraising, and that's how we did it also for Fund 2, we want to be on the market very quickly. So we, for example, only do one closing and one final closing, and then basically try to make sure that everybody comes to a decision fairly quickly, build off of the conviction that they have established into us. And so we were on the market over summer last year, and then basically closed in early Q4. And for us, the biggest learning there was the same thing that every good founder would do in their fundraising: deadlines, get deals done. That's the best I can summarize it.
Okay, sounds like a very successful process. And also, I love that saying. I've not heard that before. There's no fun in funerals and no fun in fundraising. So I'll definitely remember that. Conan, then this is also a question I feel like everyone wants to know the answer to. What do you think makes not only a good, but a great VC investor?
I think I'm going to start with empathy, and actually for any VC investor that's actually been responsible for the fundraising of a fund, at least they get some empathy around the challenges of fundraising. But I think ideally as well, a great VC investor has empathy and understanding driven by ideally some operational experience. I think it's very hard to really both assess companies and understand the entrepreneurial challenges and journey without in some way, shape or form having seen those challenges yourself at first hand, whether that is as a founder or an early employee in an early stage business. I think that insight that it gives you is hugely valuable. Beyond those sort of personality and experience traits, clearly, I think we'd all agree on this call that a degree of sector focus and understanding is a significant value add in terms of helping founders on that journey, not just in terms of general operational experience, but also in being able to provide insight and potentially introductions to useful businesses, useful customers, useful potential employees within the space. So that's what I'd say: empathy, some operational experience, and then a sector focus. all help make a great VC.
And if I can add maybe here a comment, because I reviewed recently a study from basically a company analyzing more than 800 VC funds in Europe. So it was a big bunch of cross-industry different VCs. And the conclusions of this report was mind-blowing, saying that actually funds don't perform. They were saying the average performance of the 800 VC funds was something around 2% IRR. Can you imagine that? And they were saying only the top 25% VCs were doing double-digit returns, and only the top 15, 1.5, were doing more than 20% IRR. So when I saw this, I was like, okay, but then what does it mean? Does it mean that 75% of the VC fund don't know what they do? So I don't think it's the case. Maybe it means that they don't have access to the best deals. And so thinking of this, I thought from an outsider, because I'm just a trend watcher, I thought that maybe what is the most crucial is the access to deal. So if you have access to the right deal, so it means knowing when the right startups are raising capital, but also have the identification process internally to make sure that you spot the champions that can reach 100 million in revenue, for instance. And also have the right USPs for startups to make sure that they select you instead of another VC fund, because I guess the most successful founders are cherry picking their investors. Probably also the curation is very important after the investment. But I think the value add of a VC, or what is like the skills that the VC needs to support startups to become successful, depends also on the stage of maturity of the deal, because a seed deal will require a lot of time, while a Series B or a later stage, they normally need less time investment from the VC side. So yes, this would be my comment on this one.
Thank you both for some very interesting input. In particular, Conan, I love that as the first criteria you put as empathy, very unexpected, but very obviously great criteria. So on the point then of, I suppose, personality traits, over to you, Kingma. What personality traits do you think, or do you look for in a founder? And also, can you share an example of what your ideal founder would look like?
Sure, I think that's a great question. So I've been working in PropTech VC for about 3 years now, but before going into PropTech VC, I worked in a few startups, and I was actually incredibly lucky early on in my career to have joined in particularly 2 startups who became very, very successful. The first one, a company called Dilan, is sold for about $500 million US about 2 years ago. The second one is called a company called Bought by Many, which is now the largest insurtech unicorn in UK, and with valuation of £2 billion. So I was very lucky to have been involved in both those companies at a very early stage, and therefore I've worked very closely with the founders. And also, like, kind of throughout, I guess, my career, I've been very fortunate to have worked in other companies as well, where I've kept in close touch with the founders of those companies. And so there's some kind of, I guess, general patterns that I think I've kind of seen in terms of very successful founders and business people ultimately. I think one of them is definitely that the greatest founders really spot very, very good opportunities very early on and are able to lead, you know, themselves, their investors, their stakeholders, their employees, etc., all on board to kind of realize this opportunity and just kind of relentlessly drive towards it in a very, very speedy, but also very, very focused way as well. The founders I've worked for in startups have very different personalities. Some I would say are kind of less organized, but very, very, very fast. Others are very much more kind of structured, strategic. But regardless of their kind of unique kind of personality traits, they are all kind of really recognize this opportunity and able to kind of persuade a greater number of essentially people and resources to kind of be invested towards them in terms of getting that vision. So I think that's definitely one. And certainly now, as working, of course, as a VC and speaking to many early stage founders looking to raise capital, that's kind of one of the first things that mentally and emotionally I kind of want to assess as well, whether I am really convinced by that kind of narrative that they're pitching me. Does it kind of resonate in terms of my heart and mind as well? So I think that's one really, really crucial thing. And I would say the other kind of crucial thing is really, does the founder actually know exactly the challenges and the market that they are trying to adapt? I think one of the kind of advantages or benefits that we have as kind of PropTech focused VCs is, of course, we have a much bigger understanding and deep understanding of, let's say, how the real estate industry can be broken down into the construction markets too. So therefore, it's also quite, maybe a bit of an easier job for us relative to, let's say, generalist VCs, of kind of really recognizing, what are the assumptions essentially that the founders are making in order to draw to their conclusion, whether it's actually realistic or not, given this is how the market works, and also who maybe some of the key players are in terms of incumbents, in terms of other startups in that area as well, that we can quickly talk to, just kind of get a reference check. So yeah, there's lots of maybe founders with good ideas, but without the have they actually tested? Have they got the experience? Have they got the network essentially to be able to execute on an idea? Yeah, I think it's a whole different story. So I think that's probably the second part.
Yeah, execution is definitely crucial. If I may also add a few comments here, I'm super agreed with what you just said, Kingma, and from the PropTech Lab perspective, so we have the chance to be surrounded by amazing entrepreneurs. Some of them are amazing, not all of them, but we have now 160 companies, startups that are members of PropTech Lab, and so we have been able to follow some of them during the past 6 years since the beginning of this adventure. And so I think it's always super hard for me to identify what makes a quality person, what personality traits makes from an entrepreneurship standpoint a quality person. But I think some of the key elements could be the following ones. So you mentioned already a lot of them, so I don't need to repeat them. But I think also humility for me is something that is very important, because probably it means they are humble. I think all the most inspiring people that I met were the most amazing people that I met so far were always super humble, always willing to learn, to get feedback, to listen. And I think the ability to listen is crucial, and it's not always easy to listen, so this I would add, of course, the fact that they're in love with the problem that they want to solve. So the founder problem fit, and also do they know, have they experienced the problem that they are trying to solve? So this already mentioned. And also, I think another element is the resilience. So how resilient are they in terms of crises, in terms of when they have hard times, how obsessed are they, and how resistant are they in context of problems? So I think this is super crucial. And then, of course, the vision and the execution. So something that is great is when they have playbooks. So I love when they are data driven and when they have playbooks to document the best practices, to document, to scale the operations. So if they are able to build great playbooks, for me, it's already a fundamental piece in their growth, in their path to the growth. So yes, this would be my take.
Thank you both. Again, two very interesting answers. Obviously, we can see some traits you name in common, others you approach from different angles. But I would say, if I understand correctly, to summarize, you both agree they need to be great visionaries, great salespeople as well, to get buy-in from the stakeholders around them, and then have overall good people skills. So on the flip side then, Kingma, what personality traits in a founder are a no-go for you? Where would you say, okay, they have their pitch deck was great or whatever, but I just, as a founder, it's a no for me?
Yeah, so again, that's a really good question. I think Idriss did a really good job of listing many of the kind of more specific traits or factors that we would like to look into. I think, Dilan, you mentioned the word sales, and so sales is one component of more broadly leadership, and there's certainly a lot of factors which I don't think make a good leader. For example, maybe something like ego, or maybe something like arrogance, or maybe something like impatience as well. These are things which are quite, I think, unattractive traits for anyone kind of to really be spending time with, and therefore I would question, their ability, let's say, to lead a kind of organization. I think that fundamentally, you know, as an investor, when we're speaking to a founder, you know, we're building a relationship. I think Patric gave a very, very good summary of how he, you know, how Fundamental has been very successful in fundraising, which is fundamentally the time and the effort, energy that he's built into building relationships with the investors at the point, way before the point of closing. And I think it's a very similar story as well to startup founders too, that, you know, ultimately they have their own personality, their background, and they're speaking to someone who has his or her own personality backgrounds too. And so is there a match? Is the founder essentially smart enough and emotionally intelligent enough to be able to, you know, build a trusting relationship of mutual respect, of mutual understanding with that investor? And if they can't, because of certain personality traits, and I think I can spend a lot of time listing what some of those are, then there'll be a no-go for us.
Thank you, Kingma. Again, very interesting. And I mean, again, this would be a conversation for a completely different panel, I imagine, because our focus today very much is on Europe. But I wonder if some of those characteristics you've listed as a no-go in Europe would actually be a preferred characteristic in some of the other markets like North America. But like I said, that's really just assumption on my part, a conversation for another day. On a totally different note, Patric, a very question for you. So other than obviously the financial gains, what excites you about being a VC and being able to work in this job and in this industry?
Sometimes I ask myself that question, to be honest. And it's, for me, so like so many people that do a similar job, I honestly have no idea how I ended up here. It kind of was a series of serendipitous events, and all of a sudden you have the chance to be an investor. That certainly was for me the case. It was never planned. And so some people have a certain vocation in life, or they have a certain dedication over multiple years to become exactly that type of role. I can say that was not the case for me. And so I cannot look back and say, okay, finally I arrived here. That's not it for me, but it was much more surprising almost how I ended up here. And now in hindsight, I must say, I'm not sure I would be happy to be any VC. So for example, if someone, you know, had offered me to be partner in a generalist fund, I'm not sure that would be for me. What I really enjoy is being a vertical investor, because it allows us to do two things: playbooks and partnerships. So when I speak about playbooks, keep in mind, Fundamental invests globally. So about 80%, we are a German domiciled BaFin regulated fund, but 80% of our capital actually leaves Europe. It goes into Asia Pacific, it goes into Latin America, it goes into North America, and now also goes into Africa, and 20% stay in Europe. And that's partly portfolio strategy, but it also comes from a deep-rooted belief of my partners and I that we're able to spot certain patterns and playbooks that we can inject or help inject into our portfolio companies, because they don't compete. A good example is we were early investors in InfraMarket, which is the leading materials marketplace in India, multi-times unicorn, helped us, you know, generate returns in the first fund. And it allowed us to spot a certain pattern of what works around the procurement and the supply chain element of emerging markets construction, to spot then a company named Tool in Latin America, which is now sure to become a unicorn as well, and where we are early investors as well. And we would have never found Tool without the experience in InfraMarket. Never, I can say that. So the playbook and pattern recognition for us is really something that as a vertical VC, I enjoy. And then the partnership element, again, is something I feel we can help, because we are verticalized. We can make certain connections with players from the global construction industry on market entries, on joint ventures. That's something that we have helped companies actually set up joint ventures for entries into Africa. And that's something that as a generalist, I think you can do it, but you have to be really long in the market. Whereas as a vertical and more focused VC, like any of us here, our network being more specialized, you can help with partnerships even early in your fund journey. And so that's the other thing that I really enjoy about being a vertical VC.
Great. It's great to hear that you're so passionate about what you do and the vertical you operate in. Obviously, I can very much relate from my side. I'm not a VC, as you all know, but we're very much industry specific. I don't think I would love or enjoy as much what I'm doing if I was a generalist recruiter. So I can relate on that point. Patric, another question for you. How do you manage the relationship with your founders and portfolio companies successfully?
I can give you a short one, and then you tell me if you want a longer response, Dilan. So it's mostly being online 24/7 in WhatsApp. That's pretty much what it comes down to for us. We don't take board seats by principle, even not board observer seats. We take very rarely, only on request. Our whole relationship happens actually, let's say, in the trenches. We're pretty. I think we pride ourselves in being more responsive to our founders and our partners than any other investor. When you write me a WhatsApp, you typically get a response within a few minutes. And that's something that really also drives trust and collaboration.
Do we want the long one?
Why not? Absolutely. Let's give us the long version.
Maybe I overpromised there. I'm not sure I have much more of a secret sauce there, but so I think that's one element. And then outside of that, we've, you said in your previous question, Dilan, outside of financial gains. Now, there is a correlation between, at least what we have experienced, there's a correlation between financial gain and the strength of the partnership a portfolio company has with its investor. We've actually made the experience that the best performing investments for us are the ones where the founders take care of the investors and the investors take care of the founders. Classic example, when it comes to an oversubscribed round and the founder sometimes has the idea of asking the existing investors to let forgo of pro rata. Sometimes that's necessary, and then you compensate each other at the next round. And sometimes the investor needs to go over pro rata because, whatever, the quality of the round maybe wasn't there. So taking care of each other, if both sides really agree to that, is something that can drive financial returns in the long run. And that's something where we are very invested. We're happy to work with the founders, but we also like to be taken care of. Yeah. And then founders, I think, are at least the good ones are never penny pinchers. The ones that I know are always very happy to take care of their investors who have been useful to them in the past. And so that really is something that I think every investor is striving towards.
To comment here, a few stuff. We have seen a couple of relations between founders and VCs that could deteriorate, and sometimes it was just about problems of alignment. And so I think it's also crucial, from again a trend watcher point of view, but I think it's very crucial to be aligned on the risks that the VC is taking, also the capital exposure. So are they able to do follow-on investments, yes or no? And it's important for the founders to be aware of this. What are the conditions for a follow-on investment? Also maybe the timing of the exit, because if as founder you need 6, 7, 8 years to make your company gigantic, but it's year 4 of the closed-ended funds, and so they need to exit in the next 5 years or 6 years max. Maybe you have a friction in terms of time horizon, so it's also crucial to be there. But if I think out of the box, and if I put myself in the shoes of the entrepreneur, which I am, and also to echo what Conan was saying before about empathy, I think it's also crucial from the founder's perspective to have an investor who is able to guide him, I would say, almost in the personal life. So it's a bit out of the box, but I think something that the founder of The Family was saying, so Oussama Ammar, who is very inspiring to me, was that he has built a circle of unconditional love, a sphere of unconditional love and support in his private life, close to him, which makes him the feeling that he's invincible. And I think when you have when you're very successful in your private life, it will also fuel your professional success. And so I think it is very important to also take care of this. So I'm not saying that the VC should be a private life coach or something like this, but I think if the VC has an idea about the cost of the success, and also to help the founder to re-clarify a bit the priorities, including sort of equilibrium private life and professional life, that could definitely be helpful. And it's also related to the idea of being available 24/7, of course, I assume. Yeah, so that would be it. A bit of an unorthodox answer, I guess.
Thank you both. Again, some very interesting points here again. Obviously, I started my own business when I was 23 years old, and I had a mentor in the background. It was definitely very, very helpful having someone in the background that you could reach out to whenever you had a question. So I am sure any founder appreciates being able to have that kind of access to you and your team, Patric. Kingma, again, another topic or another question. How do you work with your LPs? How closely do you collaborate with them? And can you share some tangible examples with us?
Yeah, sure. I can share some examples straight off, I guess. So one example is, so I think Fundamental actually have this shared LP with us in Klaus Freiberg, who was a former CEO of a large real estate company called Vonovia. So Klaus has a huge amount of experience in residential real estate. And one of the companies that we invested in is called EcoWorks, which is a retrofitting company for sustainable retrofitting company for existing multifamily residential buildings. So EcoWorks we invested in at a very early stage. And so to kind of bolster up their board and their strategy, we introduced them to Klaus, who subsequently invested individually as well as joined EcoWorks board as the chairman of that. So since we have quite a large number of LPs and many of whom are involved in very different facets of the real estate industry, some as individuals, some as companies, we like to matchmake essentially the companies that we've invested in with the relevant areas of what our LPs do. So that's, I think that brings a lot of value to the portfolio. But similarly, LPs also can bring a lot of value to us in terms of our due diligence process as well. So for example, when we first invested in Desana, which was our first UK investment, it's a marketplace for co-working spaces. One of the sounding boards that we went to is one of our, again, individual investors called Timo Schamler, who used to be CEO of JOL in Germany. So of course, huge experience, huge network when it comes to real estate office brokering. And so it was really important for us to kind of get his view in terms of both Desana itself as a company, as a solution, as well as more generally how he sees the trends back in 2021, of work from home and therefore the impact that has on the office real estate vertical as well. So each one we have pretty different structures. Some of the companies, I think we have a more of a regular kind of meet up with them and their technology/innovation team so that we can share ideas of what we're looking at and what they are looking into as well. Others, maybe they have a kind of much more relevant direct experience and network to bring to the companies we've invested in as well. So that's why we're very happy and very proud of having, let's say, a bunch of very relevant investors to our fund, which we can then use to help or add value to the startups we invest in.
Right, thank you, Kingma. So it sounds like, if I understand correctly, again, there's definitely a massive benefit to being vertical specific rather than being a generalist, and then the whole ecosystem. So both your LPs as well as your PCs benefit from each other. I don't want to say equally, but in different ways. Brilliant. Conan, over to you. So tell us about some of the biggest challenges your portfolio companies have faced to date, and how have you supported them during those challenges, and maybe also after?
Sure. I mean, I guess to start with, I don't think my portfolio companies or companies I've invested in previously have had any particularly unique challenges. I think you see the same challenges being repeated over and over in startups, and it really depends at the different challenges at different stages rise to the fore. And so I may give a bit more of a generic response to this and then draw out a couple of things that I think are important along the way. So, in the early stage businesses, which we're talking about, less than say $1 million of revenue, what's the biggest challenge they have? Well, in most cases, it's finding that scalable product market fit. And so then it's about providing insights, encouraging them to iterate, supporting them and giving them ultimately enough runway to find that product market fit. And then, of course, as they move past that stage and they have found product market fit, then the next challenge becomes, how do we generate scalable, repeatable sales? And, there are always multiple challenges, but that's the one that sort of rises to the fore. And so that takes you from 1 million to a few million. And then very quickly, another challenge that has been present all along, which is, how do I bring the best people into this organization? Really, I guess, rises to the fore in my mind. I mean, recruitment is a constant challenge. Like, as a founder, you are always selling. You're either selling your product, or you're selling your company, or you're selling your company and your product to potential employees. And so recruitment remains a challenge throughout the company journey, because ultimately a company is nothing without bringing in the best people. But really, at the stage at which it sort of pivots from being really a startup to a company that's scaling, then the ability to recruit, retain, and manage high quality talent across the functional areas becomes sort of the new challenge or key challenge I think the business faces. And linked with that, the challenge there you see is then around founder evolution. What is the nature of that founder? Is that a founder that's going to be able to evolve with the business from being the guy that's scrappy, just trying to get a product and find something that people want to buy, through to a scalable structured business, through to something that becomes where they become removed from day-to-day operations and really they become a manager of other people with functional responsibility? And so then it's a question of like, is that it helping, I guess, the founder or founders identify and whether what they want to do with them at that point. Like, are they the right person to take the business on in the future? And if they are and they want to, what support do they need around them in order to make that business successful for the next stage of growth? And those, I think, are all very standard problems that I've seen companies face, and I'm sure most of the other investors in the call would agree with that, and they might prioritize them slightly different or say they see different problems at different stages, but broadly are some of the key challenges you face. The final one is a funny one maybe for an investor to raise, but it's the one that I sort of find the least acceptable, which is investor-driven problems. And it never ceases to amaze me how many companies I've spoken with or that I've invested in have had problems which shouldn't have been a problem. All those previous problems are natural problems and part of the growth journey. But the problems that get driven by poor investor behavior are surprisingly common. Whether that is an investor coming in and thinking that they know better than the founders and they want to drive the business a completely different direction, and so dragging the product strategy way off direction, or whether it's simply not doing what they say they're going to do. And by which I mean, saying they're going to fund and they're not funding. I've recently been involved in a business where that's exactly what happened. There were continued promises, not just to the founder, but to the other investors that they were going to fund. And that investor never funded. And it created real problems for that business. That is sort of the unacceptable side. I think the flip side of that is ensuring, so I think Idriss's point earlier, that you have alignment of expectations between investors and the investee companies, the entrepreneurs, because sometimes I think if you speak to an entrepreneur, they can say, oh, my investors treated me awfully, when in reality, that's not bad investor behavior. What's actually happened is the investor's just done what the investor was always going to do based on its priorities and its alignment. And the founder either didn't make enough of an effort to understand what the priorities for that investor were, or was willfully blind to them. And then it reached a stage, and when the investor did exactly what they would expect to do, it led to a breakdown of relationship. So that is a different point. That is like ensuring you have alignment, but there is still a marked number of instances where you have poor investor behavior, and that is something that I guess my tip to entrepreneurs and founders is like, take investor references, make sure you understand what their expectations and priorities are, and ultimately, there is very rarely such a thing as easy money. Again, I've been involved in another deal recently where it was a very interesting solution. The founders decided to do a deal which they thought was going to be a quick deal. So they took, let us call some money that was quasi-institutional, but didn't go through the full investment process that you perhaps normally expect. And then what happened is that very easy, quick money, which was meant to do a quick deal, ended up being really quite difficult money, because having not gone through the normal process at the last minute, there were problems and concerns. And so what was meant to be a fast deal ended up being a slow deal. So I think, being realistic, the be realistic about what investor expectations are, and don't really believe that there's some easy money that's going to come along, because normally when you speak to institutional investors, they put you through a process and they put you through a structured process, and you understand where you're going to be with that. So that would be it. I would encourage founders not to be blind to that and feel that investment process are something to be put up with. You know, they're a useful process for both investor and entrepreneur. And so, you know, on that last one, I've moved a little bit away from it, which is like, you know, what are the problems you see? But that's how you, I guess, minimize the risk of the last category of problem being investor problems.
Thank you, Conan. And this is exactly why we launched Relevation, is to, I think there is so much intelligence present and not shared, and it doesn't cost anything to just share returns of experience. And I think, so thanks a lot. It's exactly the intention of the platform.
Yes, thank you, Conan. So many great points that you raised. Obviously, I know a thing or two about the recruitment struggle, but that, again, that's a topic for another day. And then also interesting to hear what you said about the founder and their evolution with the growth or the development of the business. I'm currently recruiting for a CEO position for a very, very early stage startup, actually in the DACH region. And the criteria I'm looking for, or the characteristics I'm looking for that candidate, it's very true. They would be totally different than for, I don't know, a Series B or later stage CEO or co-founder. So I agree on that point. Okay, wonderful. Another question actually for you, Conan, and probably the question should have been switched, because this goes to the start of even forming that relationship with the founders, but what has been the best pitch deck that you've seen to date, and why? What was it that made it so stand out to you?
That's it. I was giving that question some thought, and the reality is I can't think of one that jumps out to me. So let me talk again about general terms, because the reality is there's what makes a deck stand out from an entrepreneur. Like if I'm an entrepreneur and I want to produce a certain type of deck, what's a great deck for me? And then there is, sitting on the other side of the table as an investor, what's a great deck for me as an investor? You know, the truth is, what's a great deck for me as an investor is one that clearly presents the position of that business and the vision of that business, and enables the information collection that I need to make a proper assessment about that business. And, you know, all too often you find a deck that skirts around key points, problem points, and it's completely understandable, because, you know, to flip side, from an entrepreneur standpoint, you want to get the investors' attention. You ultimately want to get a meeting, you want to get in to be able to persuade them of something. So from an entrepreneur standpoint, something where you paint the vision of the business and give just enough information that, you know, a busy investor can make an assessment about that business and be like, yes, I have enough here to know that I want to speak to them. But if you're going to walk that line and just give enough, make sure that what you do give is clear and not misleading, because, you know, there is probably no more of a red flag than, you know, getting some information in one form, then taking the call, taking the meeting, and discovering that actually something in the deck was misleading. And linked to that, a pair Tate. If you're listing revenue, please never use a cumulative revenue number. It's probably the most unhelpful statistic out there, and particularly if you're not going to label it as such. You know, again, so for me, so flipping back to the investor side, what's a great deck? It's one that is clear, enables me to every piece of data is clearly identifiable and is value to me in the assessment of that business through, you know, what's the market opportunity, who's the team, what is the traction to date, what's the historic financials look like in that business, and all of it is clear and digestible. And again, you know, the other piece to consider there is what's the context of the presentation of the deck. Like ultimately, there are two different decks. There's the one that you want to talk to, and there's the one that you want to send to an investor to sit and review without you talking to it. And the reality is the majority of decks that we see are ones that are sent to us, and we're going to take a view on it based on the deck without the voiceover from the founder. So again, then clarity of presentation and not providing the relevant data without overwhelming us, I think for me is what I value as an investor.
Okay, great. So founders, listen up, get your numbers right, and get your labeling right as well. Otherwise, your deck is out straight away. Kingma, which part of your job do you enjoy the most and why?
So I have I'm very grateful for the job I have, because it's a relatively independent job in the sense that I was tasked to essentially raise the profile of PropTech 1 in the UK market. And so what that means is that a big part of my job is just to build relations and get to know people from three main buckets, I would say: the ecosystem of other VCs and private individual investors. That's bucket 1. Bucket 2, of course, entrepreneurs, and bucket 3, the kind of broader UK real estate industry and construction industries. So all three of these, different demographics and different buckets have very different topics of interest to discuss. And in terms of where we sit as a PropTech VC is really the overlap between these three areas. And so it's really great. Basically, it means that I can build a lot of connections and bridge gaps between, for example, people who are interested in innovation from the real estate industry to, for example, entrepreneurs, companies who are building solutions that might be addressing those areas of innovation interest. I can speak to a lot of generalist VCs or VCs maybe, for example, focusing on fintech and other verticals as well, where there is often overlap with that and PropTech, and again, adds kind of our area expertise. And of course, that's a really good way for us to deal share as well. So I just really like essentially the freedom that I have in my kind of quite unique and position, and the kind of opportunities that kind of get built out of that freedom. So that's what I really like. And of course, learning from all of those three areas as part of that job.
Thank you, Kingma. It's great to hear you're really passionate about what you do. Patric, we're nearing the end, so one of the final questions, obviously without giving away your secret sauce, but share with us some of the criteria by which you evaluate potential deals by.
I mean, you're not asking for the Heinz ketchup recipe here, or the Coke recipe. Ultimately, my experience is that most investors, angels, VCs, ultimately they look, or eventually they look all at the same parts of the business, but the priorities can be different. And for us, it depends a little bit on the maturity of the company, how the priorities look, but 3-4 things stand out across our interests. In general, I would say the most important currency of VC is momentum. So whether you're an early stage company or a later stage company, at some point, we really want to see that momentum build. That can be in revenue, that can be in also non-revenue terms, but ultimately the most important currency is momentum. Outside of that, the earlier a company is, the more excited we get about A+ teams, very deep markets, and sort of the less tech-enabled competition there is in market, the more excited we are. So that's pretty much in a nutshell our priorities, and the weights become a little bit different if and when a company matures, because then momentum becomes bigger and unit economics. But in the very early stage, it's really team, deep market, and the look at tech-enabled competition.
Yes, I was saying if I can jump to add, not a comment this time, but maybe a question. So sorry to steal your torch, Dilan, for one second. But and what about the valuations? Aren't they part of the way you assess deals? And have you seen crazy valuations for the moment? And are you comfortable with them, or do you try to balance the valuation with more risk? I mean, in the deal terms, to control the risk more in terms of good liver, bad liver clauses, anti-dilution, liquidity preferences, or this kind of stuff. So what about the valuations in your assessments?
So it plays quite a strong role, but the reason why I didn't mention it is because it tends to correlate very strongly with the other factors. So the better a company is in its market position and the market size that it addresses, competitive position and the team, the valuation is, and then the momentum, the valuation is going to be obviously stronger because investors know exactly how to evaluate that company, and that would be reflected in the price. So there's a very strong correlation between the two. And if you're then in a company that can ultimately still become a decacorn, whatever, the reason to get hung up over valuation becomes less. I would say that we're the most price sensitive about valuation in a pre-revenue, pre-product firm. So that's something where we really care about valuation, although caring can also be on a spectrum. If you expect me to throw a number, Idriss, I'm not going to do that because it's always context specific, right?
Okay, yeah, of course. Thanks. Over to you, Dilan.
Excellent. Thank you so much. Really also great insight. Thank you for sharing, Patric. And then we're nearing the end of our very insightful conversation. So last question directed at everyone, but starting off with Conan. What are your predictions for European investment trends in the built environment for 2022?
Oh, beware predictions. I mean, I think one that is clear and will continue will be the focus on solutions driving sustainability. Like as we move nearer to 2030 in the first set of net zero goals, and as we see increased financial focus and rising costs of capital for financing non-green assets, I think that focus on sustainability in both in terms of capital and in terms of solutions and founders coming to market and developing new products with a focus on that will be unavoidable.
Okay, thank you. I see lots of head nodding. So interesting to hear your thoughts on this, Kingma.
Yeah, absolutely. Sustainability for the reasons that Conan has just mentioned. I would also say, and maybe this is less of a prediction, but maybe more of a hope, which is that so real estate property prices have been, residential prices have been really shooting up across not just the UK, but across many Western countries and across many cities, especially in the last 2 years. There's been all sorts of different price movements due to the pandemic and due to other factors as well. And I think that there is, before, other news stories like Ukraine, for example, this week has dominated the articles. There was actually quite a lot of attention in terms of the cost of living and inflation rises and how that has a huge impact on, livelihoods of many people who maybe at the start of their career, or people who are not full-time employed but working in contracting kind of gig jobs, and ultimately lots of people who aren't on the property ladder. So essentially what I'm trying to say is that I think house pricing has a huge kind of social consequence and social impact, and it's very related to politics as well. It's very related to, for example, the UK government. The government has talked a lot about levelling up different parts of the country outside of London, and I think that's fundamentally related to towards people becoming house owners rather than renters. So I guess what I'm trying to say is that I do hope that on top of sustainability, or maybe this is actually maybe even part of the S equation of the ESG formula, is that kind of PropTech solutions PropTech founders or entrepreneurs could be looking at very smart ways of fundamentally making the barrier to entry, let's say, from a private individual's perspective, making it that much easier for them to get onto the housing market, either through financing or maybe through different forms of real estate development deployments, land ownership. I don't know. I obviously don't have the solution there. And but I don't think it should just be relying on, for example, government changes and changes through the real estate industry. I think technology could have a role here as well. And I would personally be quite excited to making an investment into one of these spaces.
Okay, cool. Thank you very much, Kingma. Also very interesting. And Patric, what are your thoughts?
I mean, I can not add much to what Kingma and Conan have said. Maybe just touching on another topic here. More specifically, we've noticed that US investors have severely retreated from the European continent, also in built environment, for the last 3-4 weeks. And it seems to correlate very strongly with the first internal CIA briefings that were given out to hedge fund managers back in early and mid-January about, you know, the buildup of Russian military around the Ukrainian border. And since then, the US investors have definitely taken slightly more bow around the European companies, both early stage and growth stage. So the bar for US investors seems to be that much higher. Luckily, I would say in January and February, European investors have picked up the slack. So I think that's something to be encouraged about. But it is probably also something, at least the way we're observing the market, that needs to continue, that European investors need to pick up the slack. And historically, European investors have not been necessarily capitalized for growth stage. So that's another thing to really watch now, also within the PropTech space, is where does the capital for the growth stage come from? Can we still rely on US investors really financing not just the very best companies, but sometimes also the number 2 or number 3 in the market? Is it something that actually the European investors need to pick up? I'm very hopeful that potentially at some point, for example, in the German ecosystem, pension funds will be allowed to invest in the venture asset class. That I think would be a big boon. But there might be more work to be done there. So that's something that as a founder, really keep that in mind in your whole burn planning, in your runway planning, in your fundraising planning, and the timing when you hit the market.
Okay.
I think if I can just quickly add here, actually, there's a really interesting point I think that Patric raised, which is also particularly, I think, affects Germany. I think, you know, my German colleagues tell me that 55% of Germany's gas supplies comes from Russia. And so going back to the topic of sustainability, I think the mission or the rationale to decarbonize because of Russia's attack on Ukraine is not just for the reason of slowing down or preventing climate change, but also as a reason to as a strategic reason, essentially, for geopolitics, for European, especially continental European countries, to be less reliant on Russia's gas supplies as well. So there could be some interesting kind of environmental solutions relating to the built environment, related to infrastructure, for example, that can really, I think, capitalize on the government's push to decarbonize even more quickly than before.
Excellent. Some great predictions. We'll all be looking back at this at the end of the year and see what has happened since then. But I hope your predictions in particular in regards to the environmental aspects all come true. And we see some great developments there over the next, what do we have left now? 9 months of this year. So having said that, then we have come to the end of this really super interesting conversation with European VCs in the built environment. Thank you so much to everyone of our wonderful guests. It's really been a pleasure having you all as part of this conversations. And also, obviously, thank you to our audience for listening in. I hope you've all enjoyed this conversation as much as I did. And until next time.